Good morning, students. Today we are here with part C of financial management, where we are going to deal with various financial decisions. As you could see, we have three segments of it: investment decision, dividend decision, and financing decision. Therefore, we will be working on these in terms of financial context. That means the selection of best alternatives, financing, or best investment alternatives. Financial decisions is concerned with these three parts: investment, financing, and dividend. Now, if we see, as a finance officer, somewhere or other you are involved with either of the three. First, when it comes to investment, what type of investment, where you want to put up? Long term, that is capital budgeting, or day-to-day working in terms of short term, that is working capital requirement. Then is financing, from where to get that money. From where to get that money? So here it comes in the form of debt and equity. It comes in the form of debt and equity. And dividend decision, which comes in the form of retained earning and dividends to be declared to the people. The same thing we have put it in the diagram format, where you could have a better understanding that when we talk of investment, plant and machinery, when we talk of working capital, the day-to-day requirement in terms of resources for production, when we talk of financing, whether we are taking debts or we are putting our own, that is equity. And if we talk of dividend, what part of profit is to be retained and what is to be declared as dividend. Next is investment, what you are seeing, long term and short term, capital budgeting, working capital. Now we'll see one by one the general approach of what are the factors affecting your investment. First goes your economic growth in terms of the nation, the surrounding where you're working, the confidence that you have, the availability of the finance, the state of technology, and the interest rate existing. Other way around, if we say now factors affecting capital budgeting decision, that means we are talking about long term. And in long term, the cash flow of the project. What is the inflow required? The rate of return, the return on investment that we talk of, and the investment criteria that is being involved. Now, if we see the working capital requirement, it is focused on the cycle of this movement where we need cash to get the raw material. Then it is being put in the form of work in progress. Then the finished good comes. Now this finished good, when out in market, goes with the sales, and if the sales goes with credit, then debtors, and finally the realization of the cash. So to ensure this cycle to continue, we need to know the working capital requirement. So we'll be seeing what are the factors in working capital requirement. First is the length of the operating cycle. To what extent you need to lock in your money. Maybe your production cycle goes a bit long, then when it is out in the market, then only you get return. So what is this length of operating cycle? The nature of business and scale of operation. Nature, some are capital intensive, some are labor intensive, and scale depending upon on what framework you're working, to what extent you're working. Now, nature of business and scale of operation will be common factor, both deciding the working capital requirement as well as fixed capital requirement. Then, seasonal factors, what I have taken in the form of seasons, will take all these cycles separately also. Then is technology and the production cycle, and credit allowed and credit availed. You cannot think only to go on giving credit without getting credit. So there should be a balance in between the two. So they both can be merged together also. We'll go for amplification on the working cycles because they are more prone for one. And the impact of different cycles we are seeing over here. Impact of different cycles. First, what you see is business cycle, where there is a boom phase, depression, recession is there, revival or recovery is there. At which phase you are, that would decide what amount of capital you need in the business. Then operating cycle you are seeing, the company purchases inventory from the vendor, the company then sells the inventory to the customer, and the company collects cash from the customer. So during this entire operation cycle, what is the need of the money and at which pace of speed is to be seen. Then product life cycle, you could see that a normal thing is a seedling coming into a sapling, then growing into a plant, then to a full-fledged tree. And after that is the decay. Your focus is that the decay phase should not come. One production cycle starts, immediately after some time you will start with the second production cycle so that there's a continuity of that product in the market, what you see in the form of green full-fledged tree. I've only taken one cycle. The series of them, they start after regular intervals, and these series will decide the working capital requirement. For example, if one seedling takes maybe 5 years and selling time is hardly 6 months. So within 6 months you have to take up new sapling also, so that by the time one is finishing, your next lot is ready in the market. And last one, the seasonal cycle, what we say, where summer, winter, autumn, spring comes in a cycle, and accordingly the requirement of the industries. For example, raincoats available only for rainy season, winter clothes, woolens for winter season. These are seasonal cycles that would decide the working capital requirement. Now, the next one is financing decision. As you could see, we have two options, debt and equity. Which way to go or in what combination is financing decision that is to be taken up. We'll take up briefly over here and then again we'll deal in capital structure this part in detail. First is, what is the cost involved in raising debt or equity? In case of debt, the cost is interest, and in case of equity, it is your dividend expectation and the charges for the flotation. Then is risk But what is the risk you are taking if you go for too much of debt in the market? Then you are putting burden on the company in terms of interest obligation. If too much of equity, you are diluting your control. So a balance in between the two to be striked off. Cash flow position has to be seen. Control, if you want to have control, accordingly the equity has to be decided. Flotation cost of getting these instruments in the market. Then fixed operating cost. Fixed operating cost regarding the organization and the state of capital market. The state of capital market which is to be taken up in terms of ups and downs. Now, dividend is a residual decision. The residual decision, as you could see, out of the profit, some party want to retain, some party want to declare as dividend. So what are the factors affecting this dividend declaration policy of the organization? First, what is the amount of earning? If there is no earning, you cannot think of declaring dividend. Second, the stability in the earning. 1 year you have huge profit and next 3 to 4 years no profit. Can you give? No. So the stability in your earning. Then stability of the dividend or the payout, what we say. Normally we prefer a stable dividend paying policy where you have to see that it is better you distribute in a rational manner with a regular return rather than giving one time and skipping out 4 to 5 times. The reverse is also not good. Then is the growth opportunity. The money is same. If you intend to put it in long term for future growth and expansion, then you need to have a hold on your dividend. Then is the cash flow position. You are in profit, but the liquidity position of the or the cash flow position of the organization is not such that you can give. Then shareholders' preference. Your investor, your shareholders in the market have certain expectations, and at times, in spite of having all the other factors going against the dividend declaration, in order to retain your shareholders, seeing the market situation, you need to declare. Then the taxation policy would decide that is the company in a position to pay out dividend or not. And last but not the least, what is the stock market reaction in terms of the transaction of the securities? If people are running out to retain them, you need to. If your competitors are giving out dividend, you need to give your dividend also. Thus, we find all these factors together would decide whether the company has to pay dividend or not. Now let us see in the terms of conclusion how all these are interrelated. How all these are interrelated. As a finance manager, when you are flowing the fund from one bracket of decision to other, it moves from investment, then dividend, and then financing. Usually, from entrepreneur's point of view, they give priority to investment, financing automatically comes. If your project is ready, your intentions are clear what you need to, the money will automatically be financed. And from a businessman's point of view, financing decision comes first, then investment decision. And dividend is a cumulative impact of your investment, financing, and the overall working of the business. So with that, we conclude. Thank you very much.